So we had day two of Fed Chair Powell's testimony to the House, I believe, today. Yesterday, the market didn't take too kindly to what he said. Today, not so much. So it started off relatively bearish. The end of the day, not so bad. We did get the JOLTS number, the ADP report, kind of steering us towards Fridays. Really, what's coming down to is are we headed towards a 50 basis point hike at this next meeting or two? The door has definitely been swung wide open for that possibility, and the markets have responded. The question is whether or not that will tip us into a technical environment on the charts where we have more downside left to go. So we're not quite there yet, but I'm going to talk about what some of the indicators are showing that suggest on a much broader level than what we've seen, that may be our destiny, so to speak, in the near to intermediate term. So I'm going to break all that down with you today. We're going to take a look at some of the bigger movers from a different asset class standpoint, and what the sector rotation is telling us. Really, it's actually pretty significant from a risk appetite standpoint. What's moving and what's not moving. It's been pretty telling. So we'll talk about that. And we'll take a look at a stock that's been a really aggressive mover, both to the upside, kind of during the pandemic era time, and then definitely to the downside last year. And it's been trying to figure things out here lately, but had a pretty interesting signal today. So we'll talk about how to trade that with our trade idea of the day. So let's go ahead and get started. Today is Wednesday, March the 8th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And there's our join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including that Market Outlook live video I told you about here that we do at 3:30 Eastern time on the days that I'm doing the Market Outlook. Come down to the bottom, click on this heart, it opens up that tab, hit the like button. Same thing here, click the thumbs up icon, takes you to this tab, hit that like button there. Again, the more you do that, we're getting close to 100 likes here on the previous tweet. It really helps get our content out to all of our followers on those platforms. So it helps us a lot. It goes a long way. That's why we always ask for it every day. So thank you to those who do like us, these posts day in and day out. And those who don't, you can do right now while you're watching the video, just with one or two easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicator. Thanks to a late rally at the end of the day that kept the momentum and near-term lines from extreme. Both of them actually were below the 5th percentile earlier at the lows of the day. So we were talking about that in our class, our options inventory trading class, that those two are a lot more sensitive to late moves. So we actually finished higher on the S&P by the end of the day. So didn't quite get back over that 4,000 mark. Didn't quite get over these two Fibonacci levels, which are important levels. Haven't really broken down below them either, so we're still kind of hovering around them. But you can see the potential of where we can drop to if we do break, right? We can drop down to that 3,800 level and basically about another 200 points, 180 points or so to the downside. Obviously, we'd be well below the 2.5% mark. You notice we are below the moving average, and it is red. But the intermediate line's actually turned up slightly. So we were dark pink shading earlier today at the lows too. But the intermediate line turned slightly higher. We went from, 35.24 to 35.77. And as a result, now we have light green shading. We do have the red line. The moving average is falling. But you can see how we're pretty much sideways. We're not really breaking down. We were pretty bullish. And just like over here, we weren't really too bearish either. We got down below the moving average, and this kind of stopped. We had this kind of 5-day decline here, boom, 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 and then just stopped after that, going into and through the Christmas and New Year's holidays, and then we rallied out of that January. So we're kind of seeing a similar setup right now on the S&P 500. When you look at the Dow Jones, Obviously bearish short-term sentiment. Intermediate line's rising still though, so you have the light green shading. You're below the moving average, again only a couple percent, so not very much. We really haven't broken down here yet. Looking at the Russell 2000, that's a little bit of a different story. It did finish close to break even at 1878.72, and today we were at 18.79, so we went up just a smidgen. Again, we were really bearish on the Russell early in the day, but the intermediate line is falling. It's in bearish territory. Again, we are a couple percent below the moving average, but not very much, and you can kind of see where we need to get down to if we're going to really start to break down, as you can see across all these other intermediate declines. Finally, your NASDAQ 100 it's actually got dark green shading because it's rising, and the intermediate line is above the 50th percentile mark. So we're in the upper half. Now again, we pretty much have been in neutral zone this entire time. Again, we got another bull tag, right? We got bull tags over here. We did close above both those bull tags last week on that last Thursday and Friday, where the NASDAQ, more so than any of the others, really broke through to the upside. Got above both these bull tags, got above the high point of this post-expiration day where everybody else pretty much got their bull tags. Really good bullish move on the NASDAQ, and it looked like, man, we were really going to take off here. And then, like we said, the last couple of days, the near-term line falling back below the intermediate line. And you can see the intermediate line is actually still below market sentiment, though they are both rising, and they are both headed towards, bullish territory, just not quite like solidly in them quite yet. And again, a new bull tag, and closing above that high would be significant. Obviously, breaking down would be significant in the wrong direction. So that's kind of the tune. So the S&P, remember, it got its bull tag over here on that post-expiration Monday. We closed at 39.97. We closed here at, the high point, was at 40.52. We closed at 40.48. So we never did close above that high point of that bull tag, and we've been coming down and threatening with breaking down. Remember that bull tags either start new bullish runs, really good long ones, or they start corrections, right? They start these corrections down to the downside, these intermediate declines, at the very least intermediate declines to the downside. It's one or the other, but it's definitely generally not leading to sideways moves like we're seeing right now. We technically are an intermediate decline, so I guess we could say, we do have dark pink shading, we do have a red line. That combination and the intermediate line's actually in bearish territory. So by definition, we actually have had an intermediate decline here, albeit a very, very weak one so far. As you can see, we still haven't broken that 2.5% mark. That's why you're also on the weekly chart here getting pretty much another a transition candle. We did get a slightly lower close, so that's not a higher close, and we did get a slightly lower low point. So technically, there's not any weakness there from one week to the next. But this week, we do have a higher low and we do have a higher close. So this would be our transition week. It is a red line. You can see how close we are to golden cross / death cross there. And you can see the Heikin-Yashi differential is trying to get positive. It's still negative. It's trying to get positive. It's trying to get back above that moving average, get back above zero, and start bringing that moving average up again, and kind of keeping this to a really, really weak pullback and nothing more. Similar, pretty much even weaker than what we saw in December, and that was a weak intermediate decline there. Let's take a look at the 3 green arrows charts. And you notice we do have 3 red arrows for 2 consecutive days on the Russell 2000. It's the only one. All the rest of them, the diamonds are probably the closest to getting 3 red arrows. You can see the MACD has got green, the stochastics is green, but they are that close to turning back down, and we're well below the moving average. So you're that much closer to getting 2 red arrows again there. Again, you can see the intermediate decline here. But you can also see too that we are we're not really close to 3. I think the closest to 3 green arrows we have are the Qs. So keep an eye on that. As of right now, it is a little bit of more of a bearish bias than it is a bullish bias. Taking a look at the 2-line version of this chart. Sorry, let's move over here to this one. Taking a look at the 2-line version, you can see that we're still basically just filling in gaps. And even if we were to go a little bit lower, we're still just filling in gaps. We are below the 17-day. The MACD is above its moving average. So we are in convergence mode. We're not in the divergence mode. I think you're going to have to break that 200-day moving average in this volume node if we're going to start to trend, get a directional move again. As of right now, it's a non-directional move because you're down below these moving averages, but the MACD is done. Like the MACD histogram has peaked, and you're below that. Now this is hardly a low level, so the MACD can get lower, like it did here. Like it went down, it rallied, and then actually went lower. So that's definitely a possibility here because that's hardly a extreme low level. Even the histogram really didn't get that low compared to other bearish momentum. So that if we were to do more than just fill in gaps between moving averages, then you can see either getting above the 30 will get a directional move going to the upside, getting below the 200 is going to get a directional move going to the downside. Again, for context on this, the diamonds are also filling in, but you can see if it breaks the 200, it's a free fall. You're at a cliff face right now on the diamonds. You're below multiple really important Fibonacci levels, the 200-day moving average. You can see we are below the 17-day, and the MACD, we are already below the point of control. So things are a lot more dire on that. IWM has been more bearish the last couple of days, filling in gaps though, still just between. It was briefly below the 50-day moving average as it slows, but even then, and the MACD is below its moving average. So we are in a directional move to the downside. But you can also see too where that 200-day moving average is, and there are multiple Fibonacci levels that would be significant to break below, but we are still in gap fill mode. On the other hand, the Qs, which has been the most bullish, we're above the 50 and the 200-day. The 50 is actually still below the 200. We're above the point of control, so you can kind of see this is actually a little bit more bullish. This is kind of why, like in our long-term portfolio, we do have some more exposure to these large cap growth. If we are going to be bullish, more than likely, as we've seen here, not so much early on when the Dow really took off, but lately, you would expect that the NASDAQ is going to lead these big large cap tech names. Long duration, a lot of people use that term. Those are going to be the types of names that will lead us going forward. Looking at the DMI, you can see the negative indicator is at its highest level since we had this little bullish run. The negative indicator is really starting to move up a little bit. The positive indicator, however, has not dropped, and as a result, the ADX is at one of its lowest levels. It is at the lowest levels of the past 52 weeks. So, as well, when you look at like the Bollinger Bands, the bandwidth is also, again, it's not the lowest, but it's relatively low compared to the 150-day range. It's way, way down there. So there's an opportunity for a bandwidth spike, right, for a trending move to occur. You can see we do have green dots. The bands are outside the Keltner channels, but we really haven't broken outside of either one of these Keltner channels yet. If you had to guess which one, of course, as of right now, you would guess the lower band, because you are flirting, you are above the bandwidth, but the Ichimoku cloud, but you can kind of see we're flirting with getting below. You do have a negative 26-day rate of change. There's no trend right now. So we are, again, setting up for some kind of trending move. The money flow is still negative, so that's another sign of why you would think it'd be negative. And the breadth from the McClellan oscillator is also still negative. So these are all signs, as well as when you look at the new highs and new lows, they are also negative. At this lowest negative number that we've seen in a while, well below the moving average, which is falling. So a lot of signs that would point to any trending move that would develop to come to the downside. Looking at the intraday chart, you can see we did get a lower high and a lower low, but we closed above yesterday's low, so a small positive there. Big, late little rally at the very end of the day pushed us up into these levels. Kind of stalled as we're a little bit lower in the after hours. But again, you can see if we were to get back above here, that'd be a really good sign. The Arun indicator is setting us up for some kind of spike. The high point you can see is going to gradually move its way. It's going to move over here actually after tomorrow. It's going to be over here. So it's going to work its way towards zero until we get that. I talked about last week, if we're really going to be bullish, we need to be up into this upper half of the range by the end of this week. So we still got a couple more days, but if we end up closer than here, because remember last week this is what we were looking at here. We were close to the midpoint. But instead we've been moving lower, and if we finish with the red line back up to 0 instead of below 70, see, if we don't get a new low tomorrow or Friday, then we'll be below 70 coming on Monday, which will be a very, very good sign. But if we do get a new low, or if we happen to be near the lows going into next week, then especially with how low the price channel is, again, another sign that we are setting up for a directional move to occur. And if you had to guess which direction, especially considering how low the VIX has been, a real big drop at the end of the day to 19, how low the VIX has been, how low the VVIX has been. The VVIX closed below 75 today. I mean, that's an extreme. That's the second lowest level of the past 52 weeks, only above this one. I mean, it's extreme lows for the volatility of the VIX. Again, and considering again how correlated those two things are, you would expect that they would both jump up to the upside. The low VVIX is reducing the potential for how much lower the VIX can actually get to, especially at 19. So it's we're kind of set up for, especially with the VIX, again, relative to the VIX 3M. We've talked about previously when we've been at 19, like for example over here when we were at 19 we were below 85%. Over here when we were at 19 in March we were below 85%, near 80. So not only are we not here, or here when we were below 90, we're at 19 over here on that day in the early December. So not only are we below these 85% marks, we're barely below 95. We did get a little bit more below it, but the VIX is actually pretty darn high, relatively speaking. And again, like I've said, potentially set up for a breakout move. For the VIX would be to the upside, and for equities typically would suggest more volatility. This is the VIX and where it's at relative to its average values. They've all converged on each other. Again, we are set up, in my opinion, we're set up to fill in that gap right there, at which point that would more than likely lead to more of a downside. That breakout move that the market is anticipating would be, again, to the downside more than likely than it will be to the upside. All right, now let's take a look at what's driving this price action. You can see over the past few months, the S&P is still positive. The dollar is now turned positive on the 3-month return. Had been negative for most of this period. It's now turned positive. Long-term bonds are still really negative. So again, that's a reflection of rising yields, as obviously we've noticed. Gold has benefited from the weakness in the dollar, but since that February 2nd time frame, where the February 2nd time frame where we had that exhaustion gap on the S&P 500 and most everything else, the dollar is up 4.38%. Everything else is down, and 4% or more off of their lows, but down more, 4% or more. Commodities are down as well. Let's take a look at how some of these things moved here today. So let's look at the dollar first, and you can see the nice little rally it had, getting up to its 200-day moving average, breaking up above this volume node, really working its way up to the upside. If you look at where the dollar is, how it's performing relative to its peers. Here, let's go to. That's actually the best way to look at it is this comparison chart, and let's look at just today alone. So March we'll go 7th because that's the day that ended here with this move. And you can see this is the dollar and euro up against everybody. The euro and the franc, not surprising, kind of matching returns, and the yen is up here too. So you can see that really it is these commodity currencies and the pound, and then your two Scandinavian currencies here as well, somewhat correlated to commodities. They were really, really down to the downside, right? So that goes into the 7th. That was actually yesterday, sorry. Let's go into today, and you can see now, again, so the dollar, after really taking off yesterday, today was actually down against the yen and the euro. The euro down against most everything, Mexican peso especially. But look at that yen taking off here. So Let's take a look at what that looks like on the charts. So we'll look at the US dollar yen here, and you can see what it's doing and what the dollar, like it appears that the dollar may be at the very least converging against the yen. Here's the euro, the dollar versus the euro, and the euro is really dropping a couple days ago, really dropping pretty sharply down there. And then today you can see still holding a lot of that bearishness with that strong dollar. That's one of the reasons why stocks dropped as much as they did, because that strength in the dollar there. The other reason why stocks dropped as much as they did the last couple of days is yields. Now, not so much the 10-year yield, which is still hovering right around 4%, but look at what the 2-year yield has done over the last couple of days, up to 5.06%. But if you just look at the last couple of days alone, excuse me, let's get to here. Just the last couple of days alone, we started the day right around 4.87%, and now we're at 5.06. So just like that, I mean, that kind of gives you some context on what the 2-year yield has been doing. And since February the 2nd, we were at 4% on February the 2nd when we had that exhaustion gap. And since then, we've gone up 100 basis points. At the same time, if you look at the 3-month yield, here, let's go to, since February the 2nd, right over here, we've gone from 4.64 up to 5%. So there used to be a gap, right? We were at 4% on the 2-year, 4.64% on the 3-month, and that gap has gone from about a 50 basis point inversion to now the 2-year is just slightly above it, just slightly, kind of right at break even. But the yield curve inversion between the 10 and the 2-year is down to 108 basis points now. So in the last few days alone, let me refresh the page and we'll take a look at the last few days alone here. Let's give it a second to load up. Okay, so it doesn't look like it's going to do the intraday chart because it's not going to pop out here. But let's just look at the last 1 month chart. You can see from 3.3, we had about a 90 basis point inversion, which is a relatively low level, but boom, in just a couple of days, crashing from 3.3 to 3.7. 3.3 was on Friday, and then now going into 103 basis points on Monday, and then now 109 basis points, and flirting with 110 for a good chunk of the day. Today we were at 110. Looks like the low point there, 110.7. So that's quite the move in yields. Of course, that's a reflection of rising interest rate hike odds for the Fed going forward from here. You can see the odds of a 50 basis point hike is up to 76% for the March meeting. So we have 3 out of 4 chance that we're going to have 50 basis point hike. Just on February the 2nd, the odds of that was at 0%. We were literally at 0%, and now it's at 75% odds. If you go to May, so that gets us to the 5.25%. If you go out to May, there's a 26% chance of getting a second 50 basis point hike. So we've gone from, again, 0 to 26%. We have an 85% chance of getting 75 basis points between March and May. So one's to 50, one's to 25. And of course, by June, you're looking at a 70, 79, 80% chance that you'll be at 5.7, 100 basis points of hikes at 5.75. Again, on as recently as February the 2nd here, so right in here, February the 2nd, right there. So as recently as February the 6th was the first day that we had any odds, and it was 0.93 that we'd be at 5.75, and now we're at 80% odds we'll be at 5.75. And again, once these lines get up to these levels and stay there, right, more than just a 1 or 2 day peak, but once they get up to these 60, 80% levels and stay there, then they're more than likely going to get to 100, right? That's the case. You can see for this February meeting, to get to 4.75. Now this was one of the first ones We did have relatively high odds of getting to 5% at the February meeting. It was above 60 for a while, barely above 80, but above 60. This is one of the first meetings where we did spend some time above 60 and did not get to 100, getting the 5% here for February meeting. So that's really the only one. We were just above 60, barely there for 4.75 in December, but not for very long before coming back down. Of course, we didn't get to that point. But now we are getting above 60 on on the 5.25, so 50 basis points. Where you're looking again at a 76%. If we get above 80 and then stay there, then there's a really good chance, right? Really good chance in the next couple of weeks that we'll get to that level. Again, part of the reason why is this increasing inflationary expectations. In fact, you can see the core is expected to rise up over the next couple of months. That's one of the biggest reasons why we are as bearish as we are. One other thing I wanted to talk about was that another reason why I think we're tipping to the downside on the intermediate run. So I wanted to take a look at this. So there's a few things I wanted to look at. They all kind of work together. So first is how many stocks are crossing or above their 50-day moving average. So if you look at it, we've actually fallen below 40%. That's a key number. We'll see if we can stay there. We've been there a couple of days now. But getting below 40% is a very important number on this 50-day moving average. Then I wanted to take a look at being stocks that are above below their 50-day moving average by 5%. So that would be right here, below their 50-day moving average by 5% or more. There's a number of stocks, and you can see we are working our way up to 24%. You can see kind of getting above 30% is an important level. Just getting above the mean is an important level. So we're starting to tip towards that 30% level. And then finally, here is the average price relative, average price deviation relative to their 50-day moving average. Here we go. So you can see we are getting down to 1.5% of the average price deviation from the 50-day. You can see that getting negative at all is what starts these intermediate declines, and getting that 2% or lower is what really starts that. And we were pretty bullish. We were 8% above for the average stock in the S&P 500. We were really, really bullish in August, and of course we're pretty bullish here in November and then January with that divergent high point. But now we're working our way to the downside. So that from a breadth standpoint, again, looking at the new highs and new lows and the McClellan oscillator, there's a lot of factors and that money flow that's flowing to the downside here. Let's take a look at how the sectors performed today. So give me 1 second to move us towards just how they performed here today alone. So give me 1 second here. And you can see real estate, utilities, big movers up. Technology, not typically associated with those two, but also moving higher. And materials, again, not typically associated with technology, also moving higher. Discretionary and communication services, energy, which are more associated with materials and technology, are all lagging and negative on the day today. So you can kind of see the factors, how things are moving. If you look at from that exhaustion gap peak to right now, where the dollar's been really bullish, right, and yields have been really bullish too, but commodities haven't been. You can see industrials and energy are your biggest outperformers, along with staples and technology, again, not typically associated with each other. Whereas down at the bottom, discretionary, communication services, real estate, all really lagging. I mean, really, it's just technology, which typically does fall with these guys, is the only thing keeping, in my opinion, the S&P and the Qs from being down to really, really low levels. So the S&P, that again, it seems like the market has gravitated towards these FANG stock names, and that's really helped risk appetite in general for the last little bit, as you can see there. Let's get to the meta. There we go. These FANG names are all kind of gaining some momentum. Google, Amazon, Apple, Meta, Nvidia, all gaining some momentum, and that's allowing the broader market to be. Remember how I talked about how bonds are down as much as they have been down with this rise in yields? That typically stocks would fall down a lot more. They would follow the same return for bonds, and that hasn't been the case, and this is one of the reasons why. These are acting again, behaving like they are safe haven trades and helping keep stocks more afloat and less bearish than they would otherwise be. All right, let's take a look at our trade idea for today, and we'll take a look at Datadog. Datadog was our stock. It's been one of those stocks that's been kind of in that ARK investment, COVID, pandemic, pulling forward area. Has been so bullish, but has been so bearish since. You can see kind of breaking down more than the S&P has done. We do have dark pink shading in a red line. We are breaking down below the long-term market sentiment in the bearish territory. Bearish near-term peak, very bearish, near-term peak after a bearish intermediate peak there. And then your near-term line also dropping below. You're about 8.5% below the 30-day moving average. So that's a pretty significant move. When you look at its weekly chart here, again, we had a little bit of a bullish bounce, but now we are kind of reversing to the downside. Obviously getting lower lows, lower closes. You're back to a red arrow on that moving average. The Heikin-Ashi differential is moving down with this moving average. The PPO is starting to roll over as well. Looking at the 3 green arrow chart, you can see we are below all these moving averages, breaking the 50-day clearly. The 8 and 17 have broken below the 30. We broke below the point of control. We're looking at breaking into below the value area. Looking at the Keltner channels here for Datadog, we are into the lowest quartile of the bandwidth. That's rising from low levels. So the bands themselves are breaking outside of the Keltner channels. So it appears that we are starting a little bit of a run to the downside. Where is it? There's the Ichimoku cloud. You can see we are above the cloud, but flirting with getting below it. The rate of change has gone down into negative levels. It looks like we're just starting a bearish run on this. Looking at the whole moving average for Datadog, you can see how it's easily bearish, and you look at that MACD falling below its moving average towards that 200-day. So there's definitely some bearishness associated with this chart. Getting below 50, getting below 0, getting to negative levels, or at least flirting with negative levels in those bearish territory. So what I decided to do on this was to be a little bit more aggressive with a bearish trade, and we decided to buy not the at-the-money put, but one strike out. Now it's $5 out, so it's not necessarily just one strike. It's out at 27 delta, and then sell the 60 for protection, so that and lower the cost. That brings us down to our normal. Let's get rid of that simulated trade. So there's the trade we put on during the Market Outlook live video at 3:30 Eastern time, right before the market close. We got a half a position size. We're getting about a 3-to-1 reward to risk ratio, which is perfect. Again, considering how close the max gain is to the 1 standard deviation window, you're typically getting about 4, maybe even up to 5-to-1 reward to risk ratio. The fact that we're only getting 3 is a little bit of a reflection of the high probability nature of getting down to 60, which is right there, which would be the January lows. Getting down to 60, there's a pretty decent chance of that, at least according to the options market, based off of the returns that we're getting on a setup like the one that we are doing. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Also subscribe to us at marketscholars.com for free. Follow us and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.